Morning. 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 Jim Maxwell House Blend. Nice. Good morning. Hope you're doing well. Happy New Year. Ready for a big NFP? Number 213. Welcome to FX Street, Trade Non-Farm Payrolls Live. Number 213. Pull up the FX Street calendar for us to watch that. All right, so we got that good to go. We're about 1 hour away from the release of non-farm payrolls, so we'll have an opportunity to go through and set everything up. My name is Wayne McDonell. Let me know how I can help. Before we get going, this is an opportunity to say goodbye to a good friend and a good coach who's done many things at FX Street and FX Bootcamp. Our good friend Kurt Worley, quantitative analyst at FX Bootcamp for many, many years, has passed away. Goodbye, buddy. So a moment of silence. Having known Kurt for many years, I can tell you he's a hard worker, he was a kind person, he was quirky in a great way, he was funny, he was smart, and he was kind. But that reminds us, that ring on my finger says memento mori, means your time will come to an end. Remember, death. But what the Stoics were telling you is that time is limited, time is precious, time is a factor, so you got to live for today. Make today count. Memento mori. All right, so let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay happy, stay humble, focus on the long term, and never risk money you cannot afford to lose. So what we will do today is we will, I think we should go to the Fed a little bit. Let's do some let's do some fundamental analysis. We'll just go to the Fed. Okay. Go to the Fed. Yep. And we can say weekly jobless claims and take a look. Excuse me. Take a little zoom and a boom boom. Take a look. Let's try to take out some of the COVID out of that. And then down. And since, since January 2022, it's now January 2024, things have been very steady. Very steady relative to how crazy COVID was. So let's take some more COVID out and let's just zoom into sort of now what's happening. Okay, so it's all over the place. What the Fed wants is this number to go up a little bit and slowly. And so the Fed is watching this and saying, oh, all right, well, they've raised interest rates a lot. And, well, right now, it doesn't seem to be working when you measure it as weekly jobless claims. These are people filing for unemployment benefits. So they just lost their job. And, well, every time you get a paycheck, some of your money comes out of your paycheck to be saved because the government thinks you're a child. So what they do is they take some money out of your paycheck, and if you ever lose your job, then you can say, hey, could I have some of that money back? Because I ain't got no job and I ain't got no money, so can I have some of my money back? Well, okay, so the government says, all right, you get, I don't know, whatever it is, $2,000 a week. I don't know what it is. But you live on that. Does anybody know what you get? I've rarely had a paycheck in my life yet, but I don't know what you get. But anyways, yeah, so this is people that have lost their jobs and they file for unemployment benefits. And we can see right now, if this was rising, unemployment would be rising. Yeah. 200 a week. 200 a week? That's like a wine budget. Yeah. Wow. But okay, really, that can't be. That's only $800 a month. Anyways, I don't know, maybe it is. Wow, that's shocking. But anywho, the Fed wants this to go up. And once this is steadily increasing, they'll feel more comfortable cutting interest rates. And we know that that's the question on the table. And if we start to measure it, like if we were in a scenario where we were steadily climbing like this, and then we were trending up, oh, you said 70% of a salary. Well, what if you make $800,000 a year? Do you still get 70% of your salary? Okay. So anyways, so what I'm trying to show here is, well, we've lost some of the momentum, haven't we? Yeah, okay. Yeah, Ndello. Yeah, it's cool. It's interesting. Yeah, if it's your money, I guess you've been paying it for some time, right? But it seems to me that there'd be some max. You know, I've met people that have made $8 million a year and were broke. And when I say 8 million, I'm just expanding on the idea of 800,000. I actually know it was quite a bit more than 8 million a year, and they were dead broke. Yeah. But anyways, that's kind of interesting. I wonder if some people in finance, they may make, let's say, $300,000 a year salary, but then they'll get an $800,000 bonus or a $1.3 million bonus. How does that work? You know, because you wouldn't pay it on your bonus, but you'd pay it on your 300K. But anyways. Yeah, interesting. All right, but you see that we've lost this trend, guys? And that, I think that's going to be concerning to the Fed. Now, we are looking for unemployment to fall. That's what many of the experts are wanting to see. They want to see, so what does FX Street say the number is going to be? 175? Okay. And I think the number should be closer to 115. 170? Okay, then 110. Okay, but anyways, that would be good. That'd be a low number. And that would be good. What we don't want is a terrible number, but we don't want a higher number. But I don't think we're going to get, like, what I'm doing here is I'm taking what the experts do, and they basically probably just come up with like the 4-week average. That's probably all that is. What I'm also doing on top of that is taking out the Challenger, Christmas, and Gray layoffs. So look, let's do it this way. If the 4-week average is 175, and that's the best that the market can come up with, is they just pop out an average, that's backwards looking. If you look at the average, it's just backwards looking. And then you divide by the number. So the 3-month average, 4-month average, 6-month average, you're just adding them up and divided by the number of periods, right? Which is just a weird, strange human construct. It's not a natural number. It's something that humanity has built, created, an average. Because it's, if you think about it, the average never occurred. It's just all the different data points divided by the number of data points. And we have an average. But we know that the average never actually occurred. So that's weird. But it also isn't predictive. So what I'm trying to do is, it's, you take, let's say they're clever and this is the 4-week average. Okay, so I'll go with that. Sure, let's go. That gets us in a range. Okay, and then I look at what Challenger, Christmas, and Gray has gathered in their data analysis, and they said this month 60,000 people were laid off from their jobs. That's now. Okay, layoffs. Okay, So you just subtract. Average minus current layoffs. Now, the average would be like the average non-farm payrolls over 4 months, I guess, 4-month average. Or maybe you're using this data, the initial jobless claims data, to create some sort of mathematics that pump out a number of 170. I'm just saying that's kind of gobbledygook. I don't really like that, but so you play the game, you take the number, and then you subtract this month's layoffs. And that's not in these other data sets. That's why I do that. Wicked smart, right? Okay, and it's recently dropped, which throws the Fed off. So if this is, right, if people are getting jobs, this is people losing jobs. So if people are getting jobs month over month, is there a need for the Fed to cut interest rates in March? Let's talk about the behavioral finance issue. If the Fed are, if people are getting new jobs, is the Fed, is that a catalyst for the Fed to have to cut interest rates soon? No, it's the opposite. If people are getting jobs, the Fed shouldn't cut interest rates. Sorry, I'm eating biscotti. Are interest rate cuts by the Fed priced into the market right now? Do we have interest rate cuts priced in? How many? You probably get a different number every time you look, depending on who's telling you what. And Doug, I saw your question. If you remind me, I can answer it later today. Remind me in an hour or something. Well, that is tracked. You can get that, Gareth. That's in. See, the one thing about being quote unquote smart money, you don't rely on media to give you the answer. You can just get your answer. Yeah, which is really nice, huh? I don't know how you can calculate. Faraz, do you want me to fix that for you? It's, look at you. I'm not laughing at you. I'm laughing at the, it's probably subjective. No, it's not. Oh my God. I can fix that problem right now, Faraz. How would you like that? But anyways, yes, we have many interest rate cuts priced in, and the market is wrong. Right? What my thoughts on NFP? Well, according to the experts at FXStreet, it's going to come out around 170. There's my thoughts. Non-farm payrolls isn't the interesting part of today. It's what the Fed will do with the information. Namaste, Short Time News. Okay. All right. So the market is probably wrong. And of course, I have that data. I have all the data. And you see the little quant box logo above us? That will give you all the data. If you pay the $79 a month, and I don't think that's a lot of money, you will have the same information as a billion-dollar hedge fund that has a team of PhDs in quants. So I think I should be able to charge $50,000 a month. But, you know, 79 seemed more reasonable. But anyways, so you can get the data. But let's answer a question right now. The question is, are interest rate, the pricing in of interest rate cuts, is it subjective? No. So let's go get the facts. So before I answer this, I want to see people click the thumbs up button, the like button on YouTube. If you're watching this on YouTube, I want you to show some respect to FXStreet. Some of you may not be on. Okay. But it's a tragedy that there's only 10 thumb ups. There's only 10 likes. It's a tragedy. So I see lots of hearts, but I don't see the thumbs up changing. So maybe you're all on FXStreet proper. Let me refresh. Maybe I have to refresh to see the... Yeah, okay, it went from 10 to 56. Okay, there we go. Thank you, I appreciate that. So let's get some answers. Huh? Let's shed some light on the darkness. Huh? You want to be Illuminati? I'm Illuminati. It was cool. I'm a real Illuminati, and I'm not even saying that. I got the lamp and everything to show it for it. All right, so let's go to... All right. Oh, and by the way, this is interesting. So this data comes from contracts, bank-to-bank contracts. And this and the pricing of these contracts. So it's not subjective, it's all mathematical. Okay, to answer the question directly. It's not subjective at all. It's just simply, boom, math. So whatever the opposite of subjective, okay, quantitative. But this reminded me of something. Somebody has a giant options contract on the market today, and they need the yield on the 10-year to go above 4.1 before the end of the day. And if they do, they make hundreds of millions of dollars, and if it doesn't, they get nothing. How do you think that person feels today, huh? You think they're sweating bullets? Okay, so on the 10-year, we'll have to watch today, okay? Delete, okay? Yeah, so today, watch the 10-year, the yield, the 10-year yield on the 10-year T-note. Okay? And if it goes above... If it goes to 4.1 or above, they're going to make, I don't know, let's say at least $100 million, maybe $500 million. And if it goes to 4.09999, they get nothing. And I think we're at 4.04, is that right? 4.04? So who knows what trickery they're going to try in the market today to get that to happen. 10-year, that's JGB, 10-year Treasury. Can we, oh, I guess we can get this on FXStreet. I don't know. Well, anyways, we'll go here. Yeah, 0.04. So, see, you got to know these things, dude. No, I don't want to subscribe. So anyways, so it's a point, it has to jump 60 basis points. Yeah. What? No. It's them. It's not me. I don't have $1 billion options play on anything right now. Yeah. I have a lot of cash ready to buy later. So about 2 weeks ago, I put cash into my investing account, ready to buy after the stock market fell in January. Let me say it again. We're at essentially an all-time high in the stock market the last days of 2023, right? So I put a whole bunch of cash together. Not a whole bunch, well, some cash, thousands of dollars. And I said, okay, the stock market's going to fall in the beginning of January, so I got the cash ready to go. I'm ready, willing, and able to buy after the stock market crashes. I don't like that language. After the stock market declines in early January. How many people know that I knew, because it was my opinion, so I suppose at that time, it was my opinion the stock market was going to fall. But anyways, let's get back to this. How many people knew that I knew that the stock market was going to fall in the first week of January? Anybody? Moses, it's a few weeks. I think I'll leave it up a few weeks. So Speedy wants to know about TLT, which is the 20. Well, there's some expectation of yields rising on it okay. So actually, that's a good segue here. Jim says, "I knew you knew." Lucas, how's the $13 Coronas today? Have you had your first one yet? You're like, it's only 8 a.m. Oh my God. Yeah. All right. So let's go back to let's tie all of this into what's happening. Okay. The market thinks 170 is going to be the non-farm payrolls. Great. Is that right? Yeah, and it's going to be cold and snowy, right? Yeah. Okay, all right. We also know that the market is, well, I'll show you this in a second, but the market is pricing in significant amounts of interest rate cuts. I'll show you this. This is all fact. And because of that, there's been actually a rally in the Treasury market. And when there's a rally in the Treasury market, yields fall. All right, cool. So we got to put all this together because they're all related. So if the number comes out big, non-farm payrolls comes out big, then the investment decisions based on the idea, because remember, that's the subjective part. The market thinks the Fed's going to cut soon. Well, non-farm payrolls, if it comes out high, there's absolutely no need to cut soon. So then you have to price that out of the market. You have to take that out of the market, and that will impact things like the stock market, like the bond market, like the US dollar. It's all interrelated, my friend. Okay? It's Newtonian physics. Okay? Newtonian physics. Okay? Newtonian physics is really simple stuff. It's like if you push a ball with your finger, it will roll away from your finger. Now, that you might say, well, it depends on the mass. And I'm like, you're too smart, dude. But yes, okay. You can push a soccer ball with your finger and it will roll away from your finger. What about a 20-pound bowling ball? Oh my God, you're going to need to really push hard with your finger and it's going to hurt the tip of your finger. Well, what if it was a 300-pound round stone? Well, you can push that with your finger as much as you want and it won't get going. But if you happen to get it going, so you lean into it and you use your shoulder and you push it, oh, it'll roll slowly and it'll be difficult to stop. All that's just Newtonian physics, right? Pretty simple stuff. So cause and effect, equal and opposite, right? So anyways, we've priced in cuts and we might find today that because a lot of the smart money is still stupid, they invest based on their guesses. They invest based on their feelings, which doesn't make any sense to me. But the longer I've been a trader, the more I realize that the people I used to look up to, and dare I say worship, look at all these rich white men sitting on the top of skyscrapers smoking cigars and laughing at everybody, right? At first I'm like, I don't know what they do. And then one day I'm like, I want to be one of those guys. So look, I'm working on it. I got everything but the skyscraper. Okay. But I realized once I gained knowledge, okay, 20 years of trading experience, just trading. I was a venture capitalist before Forex. So I know a little bit about money. But after all of this, what's been exposed through looking at the facts and the details is many of the smart money people have no idea what they're doing. They have a general idea, but there's a lot of guesswork in their behavior, and it's really strange. Gareth, it's like it's a different game than we initially thought. Yeah, well, we fit in the market. We provide a certain service to the market like everybody else. But what's been uncovered and exposed, the radical truth, is that this smart money, they make mistakes all the time. So today we might find out that they've been overzealous, and they're going to need to make adjustments. Okay, so start with the thought of the headline number will matter, and everyone thinks the number's going to be low, and it'll allow the Fed to cut interest rates. Now, why would the Fed cut interest rates if we're not in recession? Well, we have a Fed funds rate at 5.5, and whatever your measure of inflation or GDP, but let's put a number down. Let's say 3.7% inflation. Maybe it's 2.9, okay? The more inflation falls, the wider the spread between, the interest rate and the inflation rate. And the wider the spread, the more the Fed can cut. You see that? It's not that we're in recession. It's that the wider this is, the more the Fed will create a recession that's unnecessary. So if inflation is 2.9 and then drops to like 2.7, the spread from 5.5 to 2.7 is extraordinary. Way too high. And the Fed can cut. In fact, they could cut the Fed funds rate to 3.5 and sit on a 2.7% inflation rate, and that would be much more normal. So the wider these two numbers, the more likely the Fed's going to cut. That's the first thing. That's what everyone is kind of thinking about. But what if inflation comes back? What if oil prices go up and push inflation back up? All right, well, people are not pricing that in. So anyway, so look up here. Okay, we have all the Fed meetings going out a year, okay? So the next Fed meeting is January 31st. Right now, there's a 93.3% chance the Fed does not cut, and a 6.7% chance the Fed does cut. Well, how do we figure that out? Okay, this is the meat on the bone, folks. Is it subjective? No. All right, let me explain. Okay? Gareth says the Fed did say the job is done. Yes, so how many people read the Fed meeting minutes? Okay? The only thing they said is that they think in 2024 they should cut interest rates. Did they say when? They didn't even talk about when. Did they say but how many cuts? 25 basis points, 50 basis points, 100 basis points? They didn't even discuss it. There was a bullet point based on the staff projections. It was noted that they should probably cut in 2024. That's it. Holy schnicker-schnocker. But you hear on TV, if you watch the TV networks, right, they're all telling you like, oh my God, the Fed's going to slash and cut interest rates soon. They haven't even discussed it. Does that bother anybody, by the way? That now the narrative, every expert on TV and every article in the newspaper and every blog post and every podcast, they're all talking about how many cuts the Fed's going to cut and how soon. And dude, they haven't even discussed it. Now, Andel says they wait for a recession. I don't think so, but I can bring that up later. What's more interesting right now is the spread, which I just discussed. But anyways, I got to get the facts out. They only said, yeah, somewhere in 2024 they should probably cut, which does indicate they're done. Okay? So there's no one thinks they're going to raise. Okay, let's go back. How do you get this number? All right, this is money, banks lending other banks money. So the theory is the bankers are smart. Okay? That's the theory. And they're negotiating money with each other. And they say, well, I'll lend you money. Okay? I'll lend you $94.67, and you will pay me back $100. So did they charge an interest rate? Is there a coupon payment? Like, how does this work? Roderick says, yeah, too many opinions and not enough facts. Well, I'm here to serve you. Yeah, Moses, we'll take a look at that. Obviously, January 10th is the big number, so we got to get to that soon, huh? Yeah. No. Look, this is the connection I want you to make. I sell you a contract. Okay, DBLK? I sell you a contract, and the contract says, I'll give you $95 today. In fact, it's $94.67. But when you pay me back $100. I've built in an interest charge, an interest fee. You see that? I give you 90. Somewhere I make $5. And what's $5? Okay, or a little more than $5, right? So what's a little more than $5 on $100? What percentage? Okay? A little more than $5 is a little more than 5%. Like what? 5.25? It's a little more than 5.25, isn't it? 5.3, 5 point something, 5.33, 5.32, somewhere in there, right? That's how this number comes up. 525 basis points. And you look at this number and you should be able to calculate, yeah, about 525 basis points, 5.25%. Oh, so that's their opinion. This is money negotiated. This isn't a survey. Money was lent between banks, and they discussed the price. And the price incorporates the interest rate. Well, what if we are negotiating July? Well, now what? Now it's a negotiation. Okay, you and the banker. Now, really, it's bank to bank. This is not bank to retail. This is bank to bank. Smart money versus smart money. All right, so we're gonna do a deal. One banker is gonna lend money to the other banker. What's the average price? That's just the average, my friend. The average. All right. I'll give you $95.27. You pay me back $100. What's the difference, y'all? A little bit less than 5, right? Right here. Now, some of the contracts negotiated were still at 5%. Almost nobody is where we are now, so that's dead. That's very unlikely. Now, some of the deals have been negotiated, and based on their pricing, you can reverse engineer the whole thing and figure out they think there's going to be another additional rate hike. This rate cut. This group of negotiated money negotiated a price, and if you reverse engineer it, there's one additional hike more. That the Fed funds rate will be at 4.25. Most think 4.75. Actually, I should say most is actually 4.5. That's the most. Thank you, Moses. And then but you see now it's opinions, right? But the cuts, if you look at the midpoint, okay, there's a 99.8% chance based on these negotiations, smart money versus smart money, that the Fed will cut, absolutely cut, before July 31st. And at least 2, probably 3 cuts before July. Maybe 4 cuts. Do you guys see that? 2, 3, or 4, so we'll average it out and say there's 3 cuts before July. So I'm answering the question now that somebody asked, how does this get priced in? How am I doing as far as answering that question? Okay. We can go to June and look at that price. Once again, just a little bit less than 5. So again, that 4.25. Killing it! Right? I'm jacked up a Mountain Dew. Yeah. I'm attacking it like a spider monkey. All right, so look. In the next 6 months, the smart money says the Fed's going to cut 2 or 3 times. Now, let's go back to reality. Snap back to reality. Mom spaghetti. if non-farm payrolls is anywhere near 170, there's no need for the Fed to cut. If inflation stabilizes and stops falling because, let's say, oil prices go up, okay, then these experts, this smart money, is grossly, negligently wrong. The market is telling us there's a 60% chance, actually 64.5% chance, the Fed's going to cut by March. And I think there's very little chance. If oil prices are going up and or inflation stops falling at the rate it's been falling, if unemployment doesn't go above 4, the Fed won't cut. The market is wrong. They're guessing, they're hoping, they're wishing, they're begging, but it ain't going to happen. Holy schnickerschnocker. Huh? Coming at you like a spider monkey. And nobody talks about this in the media, huh? Is it possible that they don't even know? That's scary, isn't it? The experts on TV don't know. The experts in the banks don't know. Are they dumb? No. Do they have the data that I have? Yeah. So why would they be mistaken? They probably don't do the work. Okay? No, Eddie, I just think they go through a process of what they believe the Fed should do. And they get onto, they're like a bulldog, and they get on the idea that, like this, like I said before, okay, the Fed is at 5.5, inflation is at 3.0, this spread is too high, too wide, and the Fed should cut to 4.5 is what we're saying, and maintain 150 basis points or 125 basis points above inflation. Yeah. That makes sense. That's logical. Yeah. Okay. Yeah. Okay. That makes sense. They're not wrong. But what if that doesn't happen? So I don't think the Fed cuts interest rates until we get below 4%. So I manage a book of money, and I started a group of people, a very small group of people by design, and they help me manage my money. And we're watching a model, and we're going to discuss it on Monday. We have a super secret model, and we need to look at non-farm payrolls and all that kind of stuff. It's part of the model, and it helps us predict the Fed policy, and in particular, recession, 3, 4, 5 months before the typical recession indicators point to recession. And then the actual government doesn't tell you. The government tells you you were in a recession 2 years ago. Well, I can't rely on the government to tell me because I'm now 2 years late. The other typical market things tell you that you've been in recession for the last 6 months. Well, once again, a little late. And so my group, the Council of Investment Advisors, right, has a model that will tell you very, very, very soon in the cycle that you are probably in a recession right now. A recession is something you can't see in the moment. It's like an invisible gas you can't smell. And there's no point in being told after you're dead that it's poisonous. Okay? So, right? The analogy I used in the training that I gave the group is like, you get run over by a bus, and then someone yells, "Look out! You're in recession." You're like, could you tell me a little sooner that the bite, even if it's wrong, I don't even care if it's wrong. Can you tell me just before the bus hits me, like, look out, there's a bus coming. It might hit you. Like, yeah, dude, right? Like, tell me a little bit before. And if you're wrong, then at least I had an opportunity to react before getting run over, okay? So anyway, part of what we're going to do is get the information from non-farm payrolls today. And this is how an institutional investor works. Like if you work at a hedge fund or a pension fund or an endowment, your investment committee will look at this information and say, okay, based on the new information from non-farm payrolls, we've plugged it into our model, and there's a significant increase in the likelihood we're probably just started a recession. It doesn't know if it's going to be mild or horrible, but now's the time before the stock market crashes. Now's the time to protect the money. Because by the time everybody else realizes we were in recession or are in recession, it's too late. The market's already crashed. You see? So anyway, that crew is going to meet on Monday. We're going to look at the facts from non-farm payrolls and we'll make a decision. So like, that's such a different level of thought process and risk management versus like a trader goes like, oh my God, it's 172 versus 170 expected. What do I do? And you're interested in a trade for the next 12 minutes. So I think the account that this group meets, I think I can't remember. It's just over $60,000, $65,000. My money, real account, real Wall Street firm. And we make investment decisions together. That group invested something like $10,000 of new capital into new investments a couple of weeks ago. Yeah, pretty interesting. So I'm just trying to show you, okay? I'm just trying to show you how other sides of Wall Street and how they look at these news events. And I can tell you, institutional investors believe volatility is risky, and volatility and risk is bad. And yet retail Forex traders, which is fine, it's not wrong, I just want you to look at the compare and contrast of the view. You want to know if it comes out 185,000, whether the market's going to jump up or down. You're going to throw down a trade, you're going to be in it maybe for an hour or less, and you want to make a lot of money. Much of Wall Street, not everybody, kind of laughs at that. It's a little bit ridiculous. But let me tell you now, I'll tell you, look, if the number comes out like 180,000 or higher, the stock market's going to fall. If it comes out 140,000 or less, the stock market's going to rally. That's my opinion. Okay? Okay. Yeah. But I'm not interested in volatility, right? Boss, okay, the number's coming out. Let me get the non-farm payroll. Let me get the calendar up. Hang on. The calendar's there. Hang on. I got to move that out of the way. Let me go into the indices. 212. Okay, that's bad, right? Yeah. So dollar's going to get ripper strong. Stock market's going to come down. Is it 216 or 164? What are you guys reporting? Let me get back to this. Let's break it down. That's Canada. Okay, 216. That's, yeah. Yeah, wowzer. So that should bring the stock market down. That should make the dollar strong. Let's look at the stocks. Oh, what did I do? Scan stocks. What? U.S. stocks. I don't know what that was set up for. And so that'll bring us down. I want you to look at 1600 as an this whole zone that I've already marked up as an area of interest. But that's terrible. And what will happen now, let's tie this in. That's not the one I wanted. That's not the one I wanted. Where's my Fed Watch tool? I killed it. Did I kill it? Anyways, if you go back to the Fed Watch tool, is it this one? No, that's OECD. If you go back to the Fed Watch tool, you will find that they have to change. They're wrong. They just realized they're wrong. And those old contracts that were negotiated were mispriced. Do you see where the language comes from now? It's priced in. No, it's mispriced. They were wrong. Okay? Mispriced. They're wrong. Let me get rid of OECD. The smart money was wrong. Okay? Yeah. Yeah. So let's zoom in. Okay. Well, actually, I'm not going to zoom in this case. What I want to get to is this. Okay, remember I said a couple of things. If the number is above 180,000, the stock market's going to fall. That means the dollar gets strong. We also want to look at the unemployment rate. If the unemployment rate is less than 4, I don't think the Fed's going to cut. How long is it going to take for us to get to 4% if we're adding 200,000 jobs a month? Dude, we got to drop this to 75,000 a month to get to the 4.0, 4.1. You see? DBLK says, why is it, but if it's positive, why is the market going down? It's behavioral finance, as I explained. The only thing that matters, DBLK, and I want everybody here to hear this clearly, the news is irrelevant. Non-farm payrolls, CPI, PCE, GDP, it's all irrelevant individually. The news just creates volatility. So the number comes out good, it's bad, great. You're going to trade it for 2 hours, and then we go back to doing what we should be doing. So you could be a short-term trader. You scalp this, you make your 80 pips, and good for you. Congratulations. Good job. Okay? These trends are lasting 1,000 pips, and you're jumping for joy because you took 80 off of non-farm payrolls. Good for you. Nice. Nice job. Good job. So what does matter then is the trend in this data. But why does that matter? Because that's the information that the Fed is looking at. Why does that matter? Because the Fed maintains monetary policy that increases or decreases the value of the US dollar. And so what I explained earlier, DPLK, just like, 9 minutes ago, that if the number comes out good, that is bad. Okay? The individual, as Boss Loss is talking about, is the individual news releases. The only thing they're really good for is creating volatility. A retail trader that likes to scalp loves the volatility. Everybody else hates the volatility. Okay? Now, Alton says good news or bad news. Okay? Now, don't confuse this with some other country. I'm talking about the reserve currency. So don't take what I just taught you and then do this on, Aussie dollar, Euro dollar, Kiwi, Israeli shekel, whatever you're trading. You're like, well, Wayne taught me good news is bad news and bad news is good news. And no, well, a couple of things. I'm talking about the reserve currency for the entire world. It's special and unique. And two, I'm talking about conditions now in the United States. Based on institutional investing, only now is good news bad news. Later on in the world, sometime in the future, good news will be good news, but right now, good news is bad news. And you're like, it's so confusing. Well, that's why I'm here. Okay? I'm not just a male model. I'm also your new best friend. Okay? But on top of all this, okay, the idea that these markets are quote unquote crashing right now, we've known this was going to happen this particular week. I don't know. So let me ask. I'm going to do one of these let me ask questions. So get your fingers ready. How many people knew that I thought the stock market was going to fall the first week of January? How many people knew 100 days ago that that was my opinion? 100 days in advance that this particular week read on the screen. 100 days in advance. So when you hear the guys on TV going, oh my God, it's a bloodbath, it's crazy, it's the end of the world, I guess it means this, I guess it means that, oh, the Fed said this, the Fed said that, oh, what a bunch of nonsense. Did I see it was overextended? No. Mr. Wright says more like 150 days. Yeah, well, thank you. I was being conservative. You can watch videos on me giving the same advice, 7 years ago on FXstreet, where I'm talking about things like this, like I'm getting ready for a big crash. It was Ross Berlin, right? I remember saying, it could be today, it could be next week, but definitely right? By the first week of January, I'm going to sell everything, right? Yeah. But that was 7 or 8 weeks ago. But all I'm trying to say is not that I'm right. What I'm trying to say is I plan things days, weeks, months, quarters in advance. So if you're good at scalping, awesome. Like, I give you a big hug. Sometimes I'm misinterpreted as like, Wayne thinks scalping is stupid. No. I think if the only thing you do is scalping, what'll happen is you're going to wear out. You're doing good now. I'll see you in 20 years if you can maintain that level of work and skill and intensity. I'll see you in 20 years. Guess what? Scalpers don't last that long. So you're like, okay. But if you scalp, then you know one very important part of the trading process, how to enter trades. And clearly, if you're a scalper, you don't have a fear of dropping trades. Where lots of people, one of the things they work on is they have a fear of trading. Okay? So if you're a scalper, well, you don't have a fear of trading. You're dropping 12 trades a day. And you're very good at price action. And you have a lot of instinct. Oh, all these things are good. But you'll never get filthy, stinking rich. Okay? Yeah, well, right. Boss is saying it too. A scalper has a completely different mindset. What I'm saying is if you happen to be that person, what I want to do is get you to think a little bit bigger. I don't want you to stop scalping. I want you to add to your repertoire. So I'm reading a 600-year-old book on samurai warfare. And it says, to be a samurai, you must master all weapons. Okay? All weapons. From things that are basically spears, to things that are basically pitchforks, to long swords, to short swords. I guess, I don't know, when I was a kid, I wanted to be a ninja. And we had throwing stars. I didn't have a throwing star. I had a rubber one. But anyways, right? And your wooden swords, whatever. So imagine this, like if you're going to be a master of the Forex universe, you will need to know how to scalp, spot, which is a session trade. A scalp you're in, let's say, for minutes. It could be 30 minutes. It could be 12 minutes, right? We know. Scalping. And then a spot trade, you're in for, let's say, 2 or 3 hours. A swing trade, you're in for 2 or 3 days. A position trade, you're in for 2 or 3 weeks or 2 or 3 months. I guess 2 or 3 weeks. And then if you're going to be in for several months, you become more of an investor. Now, on top of that, you will need to know not just technical analysis, but fundamental analysis. And if you are able to know all of these, you have the general skills of being a master, but you are not a master. What is the most important thing in samurai mastery? To become a true samurai warrior. If it's not knowing all the weapons and all the strategies, what's the most important thing? According to the rules written down 600 years ago. Your mind. It's trader psychology. For us, it's trader psychology. You can know all that stuff and still be a knucklehead. Nothing's going to save you. Dude, If you don't have the right mindset and you're like, I'm losing money, so I'm going to kill my MACD and I'm going to use the RSI. I'm losing money on my RSI, so I'm going to try stochastics. Oh, I'm losing money on stochastics, so I'm going to use moving averages. Oh, well, I don't have the right moving averages. I'll change my moving averages. I don't know how to use that, so I guess I'll try Wayne's pivot points. Oh, well, I can't trade with Wayne's pivot points, so I'll try Elliott wave. Oh, I can't trade Elliott wave. I think I'll get rid of Forex. I think I'll take a course on trading options. Jeez, criminy. Dude, the amount of time and money wasted is extraordinary. My gosh. Okay. Now, why does a samurai need mindset? Why don't you go figure that out? Okay. Oh, I gave you some. Well, okay. Well, if you have 3 more minutes, restate the question and I'll hit it hard. Right? Restate a question. I'll hit it hard. I'll give you 3 minutes. We can be done in 3 minutes. But if you got to go, you got to go. I gotcha. Okay. So my intention here, guys, is I'm just trying to open your mindset, because once you know, you're right, you can't take it back, kind of thing. Like it's gonna be like a bug digging and laying eggs in your ear. And once you know it's there, oh my God, it's gonna tick and itch and burn and sting. I think that's a U2 song, right? You want to see what the scratching brings. Da, 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 da. Dun, 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 dun. Oh, yeah. I'm not the only one staring at the sun. So anyways, all right. So Doug's gone. All right. Let's take a look around the world at the commodities. Okay. Oh, before we get going, I guess I should make sense of why all these logos are here. So FXStreet is hosting us. I've been working with FXStreet for 20 years. The way that this live stream has started, we met 214 months ago, and FXStreet and I, running a company called FX Bootcamp, well, we got together and said we want to do something unique and special. There were lots and lots of experts on FXStreet, but we wanted to try something unique and special. I had been one of, if not the first person using webinar type software. It was new type of webinar software to show their live charts. Now I know Ed Ponzi at FXStreet was also doing the same thing because we were on the same server that had nothing to do with FXStreet, right? So anyways, we got together and we wanted to do something extraordinary. And I said, well, I want to teach people in the live markets. I don't want to do a PowerPoint. That was very, 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 very unique. Very unique. Okay. And the second thing is we realized at the time that scumbags and scam artists were suckering in people into Forex because it was the wild, wild west. It was unregulated. And these get-rich-quick losers were suckering new traders into Forex to get rich quick. And they would say, look, trade non-farm payrolls. Because back then, in non-farm payrolls would jump 400 pips in 3 minutes, 2 minutes, 1 minute. 400 pips, guys. We just had an extraordinary non-farm payrolls. Compared to that, nothing happened. So back in the day, it would move 400 pips and then move another 400 pips and then drop 300 pips. And these scumbags and scam artists would say, look, get rich quick trading non-farm payrolls. And I didn't like it. FXStreet didn't like it. We were trying to bring legitimacy to a new retail industry. Retail Forex trading was brand new. So I'm talking about a time when you couldn't open a Forex trading account with a credit card. You had to wire the money. The minimum investment into a Forex account on Non-Farm Payrolls Live #1 was $5,000. You couldn't open a Forex account with less than $5,000 and you had to wire it. Then you'd get an account and there were no charts. Now, this actually shaped the way I trade. And I teach this, but I don't think like a newer trader, like the gurus on YouTube are like, oh my God, I have over 3 years of trading experience. Oh, dude, what? I have plants older than that. Okay? So, so I'm talking about a time when I learned how to trade by doing analysis first, and then you would open your chart, and then you would do your technicals on stuff you already knew you wanted to buy or sell. You didn't look at your chart to look for a reason to do something. You looked at the other way. You found your reasons for buying or selling, and then you opened up your charts, and then you would do technical analysis, completely separate. And then you would look, is there a technical opportunity to deploy your strategy? Because your decision-making process was done on your trading platform, and I did mine quantitatively. And by the way, I have a link. If you want to see how I first started trading Forex, I have a link to a free webinar. But anyways, I'd look at it, I'd do my quantitative analysis, and then I would have to do spread analysis because trading was so expensive. And then I would pair up the strong versus the weak, and then I would say, okay, I'm interested in buying pound dollar, euro dollar, and maybe Aussie dollar. Okay? It took me an hour to get to that point. Then, so now I'm interested in maybe buying these 3 pairs. Then I would go to boot up my charts. And then I would start doing like price action type analysis. Okay? But you couldn't trade on your charts. It just told you you would analyze and you would say, well, if it came back to 72.71, or if it kicked off this 21 EMA, buy it. So then you'd go back and you're like, okay, that number is, and it was terrifying, right? 72.63. So then you'd go back to your trading account, 72, what, was it 72.63 or was it 72.62? I think it was 72.63, right? And it took you a long time to open up an order. Okay, and they were much more complicated. So you would open up an order, and then you would have to go into a different type of order, and they were called parent and child, where you could do OCO. And you're like, but there's no OCO on here. Well, they do it kind of this way, but you see the problem here? You're like, wait, so what was the price? 72.63. So buy at 72.63. So now you go, all right. See how long this takes? 63. Now, how far should your stop be? You want to just have it at 72? Okay, what's your limit? And now you see all these different complications and how slow it is? 75.5. And you might be doing that just by a typical spread, or you might say, okay, now make it M4 and make this below this. Well, the problem is you would have to do this manually. You couldn't do it just that easy. You would have to go back and then adjust. And that would be a typical trade. but I would have had to have figured out that I wanted the up long ago. But it set up the mindset. That I knew what I wanted to do before I even looked at a chart. And that's very important. And at FXStreet, we decided, well, how do we teach people this? If I can teach you in the live market and you're with me during non-farm payrolls, you're not with some scumbag scam artist. So that's why not only do I open up an hour before the news comes out to explain a better way of thinking about being a Forex trader. Okay, and I do believe it's a better way. The second thing is, then the news comes out, but then you're hanging out with me and not some loser scumbag scam artist who's probably never been licensed and registered, who's probably never managed other people's money, probably doesn't even own their own car or their own house. They probably lease their Porsche. Okay? Probably never passed the Series 3, never spent hundreds of thousands of dollars being regulated, probably doesn't have hundreds of thousands of dollars in education, definitely not an Ivy League degree in economics and finance. Why? Because they don't have the skill, the discipline, the focus. They don't have the ability, and they don't have the money. They just don't have the money. Okay? They rent their apartment and lease their car. And you're like, look at them, they drive a Lamborghini. Yeah, it's a $2,000 lease. But because of that, he doesn't have a retirement account, nor does he raise children. Why? Why does he not have a family? Well, probably, again, not enough patience, not enough discipline, not enough consistency. Thing about being a parent is you have to be a parent even while you sleep. By the way, 6 months ago, my son opened up his Roth IRA. He's 17 and he has a retirement account. He's got about $2,500 in it now. Money he can never spend until he's 70. He's a teenager. My daughter just opened hers. Let me tell you how to go from poor to rich. Do you know what I have to do to ensure that each child has $1 million tax-free cash by the time they're 55 or 60? Okay? Yeah, probably, boss. I'm trying to tell you the important rules of life and that all these things are in motion now should have been planned out a couple of days ago. That's what I'm trying to say. If you're reacting to the news now, you're not doing it right. That's what I'm trying to get across. And then I'm like, so how do you look at money? How do institutional investors look at money? How do other people look at money? A lot of people here want to get rich quick. That's nearly impossible unless you win the lottery or rob somebody. Rob a liquor store. You just got rich quick. $300 in your pocket. Okay? I just gave each one of my children $1 million. Yeah, and Ross, I use the news. Do I trade the volatility? Not really. What does it cost me to give each one of my children $1 million tax-free? They never pay taxes on it. The reason I bring this up is, well, you can do this too. Does anybody have children that are in their teens or 20s? This number actually works based on your early 20s, so they'll actually get more than $1 million. How many people have kids that are like around the age of 20, between 16 and 26? Anybody? Okay, so if you're in the United States, you need to make sure they get a job. Okay? Good. They have to have a job, otherwise, well, they'll remain children for a very long time. Okay? Great. So, you open up a Roth individual retirement account. The money that goes in there is post-tax, so I already paid taxes on my income, so now I have some money. And I can slip it into this account. Technically, it's their money that they invested from their paycheck, but whatever, it's my money. Okay? Now, they are investing their money. I'll just slip a little extra in, a little something, something. And when you compound that over, even by the time they get to 55, it's over $1 million, okay? So the question is, if you have a child that's around this age, here's what it costs you to give them $1 million. $50 a month per child. Zach, Zach was the guy that was heckling me like 5 or 6 years ago, wasn't it, boss? Is that you? Or do you know Zach? That's funny. Okay. No, well, they need income on hell. You can't have a retirement account if you don't have income. That's why they need a job. Okay? So anyways, $50 a month from about the age of 20 to, now if they're 25, you might have to do $50 a month until they're 60. Okay? But that's all it is, guys. How many people here could afford $50 a month to give their child $1 million? By the way, they never have to pay taxes. Mika, I don't know. I don't know that. I don't know. I just don't know. Maybe. I don't know. You talk to a tax attorney. It's probably not difficult. So spend $200 hiring a tax attorney, because a typical accountant and stuff, they don't know these things. Okay? So hire someone to talk about it. But see, here's the thing, and this is what got me on this. Everybody's trying to get rich. They come to Forex.today, FX Street, and they're like, hey, I want to get rich. Oh, go talk to Wayne. Okay, I'm going to tell you how to get rich. In fact, I'll tell you how to make your children rich. Give them $50 a month in a tax-free account from the age of 20. And if you maintain the $50 a month, when they're 55 or 60, they will have more than $1 million in cash just from your $50 investment, monthly investment. That's it. Nearly guaranteed unless there's a zombie apocalypse. But mathematically, it's certain. So why do you need to be so focused on getting rich quick? There are strategies where you're like, it's nearly, not totally, but it's mathematically sound making money. Making money is mathematically sound. But doing it quickly is not part of the math. The only way to get rich quick is to gamble, to take extraordinary risk. And who takes extraordinary risk? People with no money. You'll gamble it all. You'll risk it all because you got nothing to lose anyways. You might gamble $5,000, but you wouldn't gamble $50 million. Why? Well, dude, you might lose $50 million. In fact, you'll probably lose $50 million. You're like, you know what? I'm pretty comfortable on $50 million. Yeah, so the only people that are degenerate gamblers are people with no money. So think about the opposite then. How do you get a lot of money? Not quickly. Okay. Well, Kendo, you could, I'm sure if you want to give your children money at birth, there's different ways of doing it. This is an individual retirement account in your child's name. So when my children were born, they already had passports, they already had social security numbers, like literally within a day or something, right? Yeah, Richard, I would advise you differently. Now, I don't want to be a financial advisor. I would not be a financial advisor. I knew someone that was a very, very large financial advisor in Canada, and he told me, he's like, never do it. And I said, I think I get it, but why do you think why do you not like being financial advice? And he's like, nobody listens to you. Right? Okay. So anyways, and it's overregulated stuff too. But in that case, I would be focused on growth stocks and growth and balance, not conservative and balanced, right? And you'll take the swings over decades. If you only had 10 years left, you can't take the swings. Now, Kendo says you started the accounts at birth. Probably not Roth IRAs. There are other accounts you can open, Kendo. Yes. But Roth IRA in particular is interesting because you don't pay taxes at all ever. So there's a hedge fund manager who had a Roth IRA. Now, the interesting thing about a Roth IRA is it's self-directed. But you can only put a little bit of money in per year. So it's okay if you're a teenager, but look, if you're 50 and you're like, somebody says, well, you can save $6,000 a year in taxes. You're like, $6,000, that's it? What's the point of that, right? What is that, a mortgage payment? Like what is that going to pay in the future? Like, it's so little. There's such bigger things to do with your money. $6,000 a year? That's it, right? But when you're a teenager, great. Okay? And there are other accounts that you can own for a kid, but an IRA is a retirement account. So if you don't have any income from a job, then there's no retirement account. But the upside is you're self-directed. So anyway, so this hedge fund manager, he was putting in his $6,000 a year or whatever, $6,500, I think it actually is. But the thing is, it's self-directed. The only thing you're allowed to do with this money is invest it. Now, typically it's stocks and bonds and mutual funds and ETFs right? But it could be commodity futures. It could be options. It could be real estate. You can invest it into almost anything investing related. Okay? Almost anything investing related. Now, remember, this is $6,000 after you paid your taxes. You've already paid taxes. You paid your federal and state taxes, okay? You've paid your taxes. And then you put $6,000 aside. That's that. But the thing is, for us, we're traders, right? We're all traders, right? So the cool thing is, like, if you have a 401k at work, you can't trade it. They force you to put it into a bunch of stupid mutual funds, right? And I'm telling you, those mutual funds and the mixes, they're like, we're going to put you into 60-40. That is the dumbest thing you could possibly do with your money. And then you're like, well, what about this? And they're all really dumb investment opportunities, but that's all you're allowed to do. We are smarter than that. And so we like to trade. Well, with this $6,000, you can trade it. And you can add $6,000 next year and $6,000 next year after that. Now think of it, guys. What I'm saying is, if you open up a Forex account and you're just like, I'm going to pop $5,000 into a Forex account, and you just use your cash, you like pop it in on a credit card. Dude, that is dumb. What's wrong with you? You're going to pay taxes on that money. If you did it with money from your IRA, your Roth IRA, your Roth IRA, you never, ever, 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 ever pay taxes on that profit. Ever. So here's what this hedge fund guy did. They were doing venture capital and stuff, right? So when he did a deal, he took money out of his Roth IRA and he'd throw it in with the deal. So they invest into a startup. They'd give the startup $10 million and he'd take out $6,000, 12 grand, 25 grand, whatever. Cause Roth IRAs are small. You only can add $6,000 a year, right? So he would put 25 grand in with the VC deal. And then he'd put another, and it would make money. And then he'd put another 25 grand into this deal, and then all of a sudden the account was growing, and then he'd put 50 into this one, and then it would grow and 100. Turns out he grew it to $6 billion. And when he retires, that's just his Roth IRA only. When he retires and he starts to spend the money, he pays no taxes. $6 billion tax-free. Oh my God. Yeah. No, but think of like my kids though, like they're teenagers now. So let's say they go to university and then they go to grad school, and in between there's a year for work and all that kind of stuff. And so when let's say they're 30 now, so right, like 15 years from now, they've been saving money in this retirement account and they're ready to buy their first apartment or their first house. Maybe they're going to get married and they're going to have kids, so they need the first house. You can take money out of the Roth IRA and invest it into your first house. And now your retirement account is invested into your house. 20 years later, you need a bigger house, or 10 years later, because usually you get extra kids and you need a bigger house and you can afford a little bit more, right? You can flip the house, make $500,000 and have no taxes. You're like, oh my God, rich get richer. And the poor gamble what they have. Money is easy. It's starting that's difficult. Yeah. So anyways, we can get back to trading. I know I made some of you guys mad. There's only 8 people left. Know your customer. I'm not going to do it, but it'll be early next week. Sorry. Yeah, Kevin, I believe that is right. Peter Thiel. It might have only been 5 billion. I might have been exaggerating. So you guys are like, yeah, that's one hell of a strategy. Money is taught, if you grow up rich, let's say you had a family that had $200 million in the bank. You would be taught completely different values. Kevin says, no, he looked it up. Yeah, look, I wasn't bullshitting. First time for everything. Yeah. The thing is, if you had $200 million, if your parents had $200 million, you'd live in a different neighborhood. You'd have different friends. Your family would probably be different personalities, let's say. You'd have different mentors, people to mimic. You'd go to a better school. You'd have better teachers. You'd have better support. Your friends would be better, or not better like, but just like different, let's say. And you would go to a great university that would teach you all, like Harvard is different. If you go to Harvard, they will give you a different education than a poor state school somewhere. You will. One just gives you accounting classes. And all the homework and all the tests are in the teacher's textbook. And then you buy your textbook and then you read it, and then there's going to be a quiz and you take the quiz and okay, you're going to learn some accounting. Great. Harvard builds leaders that are expected to change the world. It's a basic level that's driven through you at every point, through every minute of being at Harvard, that you need to influence society. Ideally, to make the world a better place. It's ingrained into you from day one. A much different education, right? So what I'm trying to say is, I was raised poor and I was told to just work really hard. And, well, I'm a man from Canada, so keep your mouth shut. My emotions were removed at birth. It's part of being born a male in Canada. They just go snip, snip, and now your emotions have been removed. And you just show up to work, you never complain, you work hard, that's it. And salsa dancing? No, not allowed, against the law. Growing up with money, this idea of hard work doesn't exist. You learn completely different skills. Maida says it depends on what Harvard defines as a better world. Harvard never defines that. Okay? Nobody ever came out and said, all right, you liberal bitches, this is how you're going to, like, no. But they do encourage a different way of thinking. There's no doubt. Okay, I'm not saying there aren't evil people at Harvard, but I can tell you with discussions with people, there's this perception of Harvard, a negative perception of Harvard that I never saw. I spent 5 years at that school. And so I was there and I saw the kids. I was an adult, right? So I'm already set in stone. You can't influence somebody my age, right? I am who I am and that's that. And I ain't no gold dang liberal, right? But I went to what's considered very liberal school and I hear lots of bad things about it all the time. But I was there and it was awesome. But there was a level of expectation that you are Illuminati. Okay. But anyway, so what I'm trying to get at is, though, this idea of hard work, it's something that gets you out of poverty and into being rich. So that's going to be part of my book. The first step of my book is, how do you go from poor to rich? Hard work is very much, okay? How do you go from rich to wealthy? Hard work doesn't exist. That's not even part of the equation. Hard work, okay? Okay, hard work. It's not even a discussion. Okay? Your money works for you. You don't have to work, your money works for you. So there's a different idea. The watch tool changed. Of course it did. In fact, we can swing around, but that was the whole point of doing the Fed watch tool. We can do it back. We can get back there again. Well, they have a video demo and stuff. It's so funny. Been doing this so long that none of this stuff existed when I learned it. But anyways, so now we're at 97. There's right. This dropped significantly. Let's go to the June meeting. And yeah, this one didn't change very much though, did it? March probably changed the most. Yeah, now there's only a 60% chance of a rate cut in March. Yeah, and it was different, wasn't it? So there's a 60% chance. Well, can I be more specific? 59.1% chance of a cut in March. And that, I think, is also probably wrong. Which tells me the move between now and March could be the same as what's happening now. Have you thought that far, guys? Could the NASDAQ fall until March? Let's say it falls to 14,000 and it takes us until March. Well, that's what it's saying. Hey, do you guys remember when we didn't know this stuff? Wait, are we thinking 90 days in advance? Uh-huh. Cool. Stock market's about to open. I would wait. Well, 2025 is probably. So what you want to do, J-Man, is, by the way, J-Man, I probably ask you this every time, but for some reason I can't remember. Is it Jagman? I knew a Jagman 15 years ago. Or is it not Jagman, just J-Man? I know you've been around a long time too, but sometimes people's names, public names change. But let's do it this way. Okay, let's do it this way. When will the Fed first cut interest rates? Well, we have to figure that out. So buying a house before then is probably not ideal. The second thing is, when will the Fed stop cutting interest rates? Well, going out to 2025, the Fed funds rate is expected to go from 5.25 down to what? 4? Illuminati biscotti. Sorry if it was crunching. Illuminati biscotti. Okay, right now the market thinks we're going to be right around 4.0. Which means you'll probably pick up a 5% mortgage. Well, right now mortgages are closer to 7. Oh man, it was so good. That dark chocolate and the almond, oh my God. Okay. So, we're at almost 7, and mortgage rates will probably drop all the way down to 5.25. So it depends on what you're trying to do. You might have to get a bigger mortgage now at like 6.5. Okay, J-Man? And then plan on refining. So let's say right now we have this idea of price and interest rates, your mortgage. As mortgages fall, as interest rates on mortgages fall, prices will go up. So if you wait to catch a cheap mortgage, you'll pay a higher price. So by and large, nothing happened. So you might as well buy it now at a high price or at a lower price relative to what you think it'll be in 3 years. So you buy it now for $1 million, right? And you get your 6.5% mortgage, okay? And then over time, what'll happen is interest rates will fall and more people can afford $1 million house. At 6.5, they might not be able to afford it because people buy based on their payments. So that means you, what is that, a $7,000 mortgage? Okay, so now $1 million house down here with the lower interest rate cost you 5%, 5K a month. Here it's 7K. And they're like, well, I can't afford $1 million house at 7K. Interest rates fall, so now it's $5,000 a month. But that pushes up the price. But you don't care about the price. You care about the monthly payment. So what you should probably do, or what I guess I should answer it this way because it's not advice to you. If it were me, I'd probably pay the $1 million now and know that in 2 years I'm going to refi at the lower rate. And I'll be able to do it because in 2 years the mortgage company, the new mortgage company, will come in and say, well, we assess your house at 1.25 M. So your debt to income ratio improves, okay? Because the new mortgage is going to be based on this valuation, okay? Your income's probably the same. And then you'll lower, and so you'll just have 2 years of higher payments, and then you'll lower it, but the value of your house has gone up. So really you want to look at it as there's a price and there's a rate. Okay? And it'll probably look like this. The higher how would you draw this? The higher the rate, the lower the price. Higher the rate and lower price. Is it like a supply or demand? The price is high. No. If the I don't want to think about it. Anyways, you're going to want to draw it that way anyways. So these things are changing as we learn. Now, think about this. You're going to do a presentation in which 1,000 people are going to see, minimum. And you come out before the news and you explain to everybody very specifically, but very soundly and very clearly articulate that all the smart money in the market's wrong. And then you explain how do you get to that process. That's a pretty big feat, isn't it? And then 1 hour later, we look in the market and we see the smart money is already adjusting. They realize now they are wrong. That's pretty cool, isn't it? Thank goodness. Thank goodness. Richard says they follow the 10. Well, it's a benchmark. But yeah. Which actually reminds me here, I want to look at the 10-year Treasury yield. Let's do it again. I pulled up CNBC last time, didn't I? Went up a little bit. Remember, some dude has got a giant bet that the yield on the 10-year hits 4.1 today. And the stock market just opened. Okay, the decrease in, the most important, we have a question about money markets. The biggest thing is if the yield on the 2-year falls, so now you can do the 2-year. And sorry, FX Street, if you got this on your site. Okay. I just Googling it. Okay, all right, here's the 2-year. 2-year pays much higher than the 10-year, right? Okay. So, how do we say this? As this falls, and it is expected to do as we normalize the yield curve. As the yield curve normalizes over the next few years, this number will fall further and further and further and further and further. You can see it was well over 5, and now it's less than 4.5. It's already starting to fall. The more this falls, the more money will leave the money market because there are better opportunities out there to earn a higher yield. Now, 5% on a 2-year is great because you're not facing any default risk. So you're going to pick up 5.25 like no matter what. And that's pretty good. But 4.5 is not nearly as good. And remember, a lot of institutional investors need 8. So you could put a lot of money in 5 and then take a higher risk on the remaining money to get you to 8. But this is falling and falling and falling. So the more it falls, the more likely money is going to leave the money market because they need to pick up a better yield. This is very institutional, by the way. I did a whole class at Harvard on this. And so the more this falls, the more the money needs to go somewhere else. Where is it going to go, AI says. Al Yee. So, does it go to the stock market? Well, that is definitely one place it's going to go. And it's $6 trillion that's still parked in these treasuries. 6 trillion more than usual because we have it's very unusual to have a 2-year paying that much. It was extraordinarily inverted. This should be 1.25. Like, can we do all time? Yeah, look this should be 1/4. It should be 0.5%. It's 4.5%. So is it likely that this drops to 2.5 or even lower than 2.5, 1.5? Yeah. And as that falls, of course, if it falls, but as it falls, the money is likely, or at least some of the money or a lot of the money, is going to have to go into higher yielding return assets. And that would be assets like the stock market. So again, I have a team that manages my money with me. Okay? The 10-year T-note pays 4.5. It's going to drop to maybe 1.5. Okay? My team and I manage my portfolio, and it earns 12. in income. Income, cash. Or 12% a year in cash. Not asset appreciation. No. I'm not talking about the stock market going up. If the stock market goes up, down, or sideways in 2024, I'm going to make 12% in cash. Cash. I can go out and buy some more stuff with that. Cash. If we have a bad year and the stock market, let's say, just kind of slowly falls 10%, it's not dramatic. It just sort of doesn't do anything because of the political risk in November, and the Fed doesn't deliver in time, and so we just kind of have a big, giant, sideways, slightly down year. I will still earn 12% cash, and then I will buy the stock market at a 10% discount. On says, what instrument do you use? Well, you can join the group. It's $2,400 a year. And you actually manage my money. Like, it's not like I just show you charts or I show you images or screenshots. We are in my live investment account, my retirement IRA. And they all voted, buy some of this, buy some of that, sell that thing, move the money over here. So it's just portfolio construction and management with my money in my Wall Street account. It's pretty extraordinary. Yeah. Yeah, if you could, you would. Yep, awesome. Well, I appreciate that. Cool. Let's take a look at some, go back to the commodities. I think HD, let me put a link to it if anyone's interested. InvestorBootcamp.com. I've done a terrible job of promoting it. I think it's this link. Well, maybe I should test it before I post it. I was typing it in the chat, but I don't even. I tried so hard. Yeah, that's it. My goal for the council is to ensure the money lasts forever, generations after I'm gone. That's what you would be joining. When I'm dead, that money, that portfolio will still be alive. The money will still be in the portfolio. It'll still be generating income and asset appreciation. And that money could be given to my grandchildren and my great-great-grandchildren, or it can go to charity and just invest the money into charity. But the principle is going to live forever. This is totally like Rockefeller. 150 years after Rockefeller's dead, his money is still growing, and it's still investing into charities and to causes that he that the family believes is worthy, like the environment. But he's dead, but his money is alive. That's what we're doing. Okay? Yeah. And the cool thing is if you join and then you quit, you can never come back. You're out. You're gone. Of course, Frank, money never dies. Corporations never die. This money will live forever. So anyways, whatever. So I want to do commodities. Give me a 1-minute break, and then we'll revisit this. Okay, we'll go through the commodities. We'll go through gold, oil, Bitcoin, dollar pairs, yen pairs. Okay? BRB, 1 minute. All right, I think that it was even less than 1 minute. Yeah, okay. Now, I stare at my charts when I talk, but then I see over here what you see, which is different from what I see. So let me explain the logos. FXStreet is our host. I've been working with them 20 years. Wonderful place for accessing experts. Okay. TradePlans.ai is something that I own. It's like a virtual coach. It'll give you feedback on your technical trading plans. How much does it cost? It's free. Now, I spend thousands of dollars. For you, it's free. I've spent thousands and 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 thousands more than that. It's free. You're welcome. The second thing, QuantBox, that's something I own. Does macroeconomic analysis and market sentiment analysis. It predicts the central banking, it doesn't predict, it displays central banking policy all the way out to 2025 for every central bank in the world. Now, where does it get that information? From the central banks. So you can look up what the Reserve Bank of New Zealand and the Reserve Bank of Australia have already told us that what their monetary policy is going to be, what interest rates are going to be, and what inflation levels are going to be 18 months out. I mean, we do all this. I mean, it's like, oh my God. It shows you the stock of capital, you know, where the money is invested by institutional investors. It shows you factually how many contracts are long gold by institutional investors like hedge funds. It's factual. I know it. You should know it. You don't know it, I don't know what you're doing then. But also week over week, how much money went into those gold positions and how much money came out of those gold positions. So now we're tracking the flow of the investment, not just the capital stock, but the cash flow. Like, how can you possibly invest if you don't know this stuff? I just don't understand. I've been tracking this stuff for decades. Now it's easy. QuantBox displays it. You know what? It's $79 a month. Trust me, it cost me a hell of a lot more money just to maintain the beast. It's so much incredible information. QuantBox.co. Trader's Way is a broker. There are many Forex brokers. A allows you to trade dollar pairs and yen pairs. Great. Cross pairs. Great. Gold, silver, platinum, palladium. Oh, good. A lot of brokers do that. Oil, both Brent and WTI. Well, a lot of brokers do that too. All right. So they have all of that. You know what's different? Those other brokers trade against you. That's how they make their money. Most brokers make money by trading against you. They hope you lose. Their business model is based on you screwing up. Trader's Way is different. They're an ECN with straight-through processing. They need you to succeed. They rely on your success. It's a symbiotic relationship. They're a service provider, a trading partner. So which one do you want to trade with? Trader's Way or a broker that laughs at you every time you lose? You choose. Another one, and this is a big one, and then we'll get into the trading. This is a very big one, announcement. I need to pull up a proper browser. Okay, well, this is good. All right, this is a big deal. When I first started working with FXStreet 20 years ago, I was running a company called FX Bootcamp. I rebranded it 6 months ago as Investor Bootcamp. So it went from FX Bootcamp, right, like FXStreet, FX Bootcamp, right? I rebranded it because I want to talk about other types of trading and investing. So the core competency here is you go to investorbootcamp.com and it's $88 for a year and you get 100 hours of videos. Okay? Learn how to plan trades, learn how to swing trade, learn the Forex basics, learn the principles of price action, introduction to Forex, how to use MT4, MT5, central banking essentials, day trading methodologies, macroeconomics, oil investing. And dude, let me tell you, these are really, 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 really good courses. They're full, like, I think this one's 15 hours. It's really good. I spent many thousands of dollars just on the research and the slide decks because I have a PhD that helps me put these things together. Now, I write the courses, but he does the research and the visuals, okay? It's $88 a year. Okay? Okay? Cool. Oh, and Dello, they're regulated by their central bank. They're not in the United States, so they're not regulated by the United States. They're regulated by their central bank. But I'll let you do your own research. All right. All right, so anyways, so there's that. And you might already know this, but if not, like, dude, seriously, $88, I would be shocked if you didn't get $99 worth of value. But what people tell me is it's worth $1,000. But I charge 88 bucks. I used to charge $1,000, actually more. So anyways, there you go. I think it shows you who I am. Okay? Now, as of Monday, FX Bootcamp is back. So at Investor Bootcamp, it's 100 hours of training videos. 88 bucks. Okay? FX Bootcamp is not a training video, is not training videos. It won't teach you the basics of trading and what a Forex pair is and what a moving average is and how you should use pivot points. If you don't know how to trade, start with Investor Bootcamp. Okay. Okay. The way that this works is it's performance coaching. FX Bootcamp is performance coaching in the live market. It's all live. There's not even one video. Okay? You meet every day at the open of stock market trading, so basically around now, just, and it's implementing processes and procedures. No, there's no theory. Okay? Processes and procedures to help you control your trading behavior and bring consistency to what you do, so you can use scientific methodology to improve your trading. So that's every day. And then once a week, you bring your trades, and now you can analyze your strengths and weaknesses. And that's your opportunity to use scientific methodology to focus on killing all the things you're doing wrong and refining all the things you're doing right. You can't just randomly try this, try that, try this, try that. What about this? What about that? Stop it. So this is hardcore. Every day you meet, every week you review, and every time you sign up for the 90-day program, it includes a one-on-one coaching call. Very, very, very personalized. Very, very, very focused. This is about performance enhancement, not the basics. Okay? Monday. Yeah. So maybe you're in a trading rut, your coach will get you out. Maybe you're learning how to implement the strategies you learned at Investor Bootcamp and you need some personal attention. We got you. We'll fix you. Tiger Woods has a performance coach. Michael Jordan had a performance coach. Wayne Gretzky had a performance coach. Are you doing enough to reach your full Forex trading potential? I don't know. Okay? Stop doubting and start doing. Okay? Do instead of doubt. To do, meet in a small group setting every day to build positive trading habits. To do, develop a clear and coherent process to prepare your trades in advance. To do, review your winning and losing trades weekly to identify ways to improve. If you don't do that, get used to your mediocrity. Stop complaining. If you're not doing everything, in a weird way, you're doing nothing. So you sign up today, set up your coaching call. I'm working on some of the logistics on that. Don't worry. We'll get you taken care of. This is a very small group stuff. There isn't 500 people signing up and no. This is terribly, terribly, terribly small. This is all about very focused, some-on-one and one-on-one. Okay? So by the end of the day, you'll be all this, right? All taken care of. So we got you, man. Don't worry. This is very, very small, very, very focused. It's all about improving your processes and giving you confidence in your abilities. Okay? So anyways, that's a big announcement. That's a whole new thing. Hey Forex Trader, my name is Wayne McDonell, and I'm super excited to introduce you to the live performance coaching program here at FX Bootcamp. See, I started Bootcamp 20 years ago. Okay, so anyways, you should check it out. If you're not ready for it now, don't worry about it. Maybe in a few months. Well, you know, Andela brings up a comment, and I'll comment on the comment. We will make FX Bootcamp exactly what you want. We will make it exactly the way you need it. So in the first few months, we are going to learn as much about what you want and about is what you need, and not just deliver what we think you need. So we're going to learn a lot with the one-on-ones and the some-on-ones. We're going to learn, and our intention as an organization is to learn as much from you about what you need. And you're trying to get a prop account with real money so you can turn that into a career. If that is what we hear from the community, we will do that. If it's just like, help me pass this so I can get a $10,000 or $100,000 account over at XYZ prop fund, well, we'll do that. Boom. We'll get you there. We'll show you, we'll carry you across the line. And I've had hours of conversation, and it's all around, we want to deliver exactly what you need, exactly what you want. So this is your opportunity to shape it. Okay? Yeah, legit. Okay, legit. All right, so let's move on.com. You can go to FX Bootcamp. Again, I've been managing that since 2004. Okay, not new. Okay, cool. All right, so let's do some gold, oil, and Bitcoin. Now, normally Bitcoin is correlated with macroeconomics, and I would propose it is somewhat still true, but we're going through a process of legitimizing Bitcoin right now. And so since that occurred back in here, I think it was, there's a new sheriff in town. The new sheriff in town is this idea that the SEC will allow institutions to invest into cash Bitcoin ETFs. And not just one, but like 5 or 6 or 7. And that legitimizes the whole industry. So that's what's at play right now. I don't know if it has anything to do with macroeconomics, although, you know, there's some risk off going on right now as expected. But how soon does the market buy? And is it going to do weeklies? Is it going to do monthlies? Is it going to do annual? Where's the base shaping on this? And of course, on January 10th, the SEC may defer and say, we don't want to make a decision. We'll tell you in September. Oh my God, right? That would be devastating to Bitcoin. So Bitcoin was worth what, 25,000? Okay. Earlier this year, it was worth 20 grand. And then it went to 50. Okay. So obviously a lot of this is being priced in. And now we wait. So I don't know if you're going to use monthly pivots. You've already missed your opportunity. So remember that $88? Yeah, it'll teach you how to set up this trade. And you've already missed it. So that's why I bring it up. Like, if you already missed it, well, you're not doing it right. That's all. So that's the swing trade. Yeah, I got to find the picture of me at the ECCB. But, yeah, I can tell you they're real people. They're real people with real education. They actually care. It's not like a bunch of thugs in the jungles, and they're like, yeah, we're the Eastern Caribbean Central Bank. Ha ha ha. They're all carrying AK-47s. No. They're real people. They're professional, educated, well-educated, professional central bankers. You know, they're real people. You're like, oh, but it's the Caribbean. Well, dude, don't discount people just because of where they're from. So anyways, that's actually a position trade. And then, of course, the other part here is kicking off the 21. They're two different things, but they are congruent. Okay? And so if you're interested in Bitcoin and you're like, I want to buy Bitcoin and all this kind of stuff. Well, dude, you've missed this twice now in the last 3 days. So you're going to have to capitulate and say you need help. You just have to stop being stubborn. There's a difference between ego and egotism. Oh, I have ego, but I am not egotistical. Okay? There's a difference. So egotistical is like, you haven't figured it out. You're trying your hardest. You've been doing this a long time and it's just not working. Dude, why are you trying so hard on the wrong thing? Get some education, then try hard. Oh, but I want to do it all on my own. I don't believe that's logical. I think you have an emotional problem. Okay? All right, so 50.6, that's fairly low, isn't it? Let me move this over. That's just volatility. That's what non-farm payrolls is. People want volatility, boom, you get volatility. Yeah. All right, so let's go into the numbers. Services. Yeah, it could be. All right. Wow. Whoa. Ah. Hey, Parikshit, thank you. I love India. Love back. Love from me back to India. Thank you, India. Thank you, consequence. Thank you, silence. Yeah. I'm overdue to see southern India. I'd like to put that on the to-do list. Northern, Punjabi food, the people, the culture, awesome. Just love it. Rajasthan, wow, what an interesting place in history in Rajasthan, huh? I like Rajasthan. Agra was, well, the Taj Mahal was nice. What's that smell? Oh, yeah, let's go back to the Taj Mahal. Yeah, I like India. India's great, but I got to get south. Get low. Delhi was just a madhouse, right? Yeah, but it's not a manufacturing. industry. But anyways, let's go in here. Okay, this is what the Fed actually wants to see. Okay, so a significant contraction. Yeah, all right. This is going to rally the stock market. That number right there. No, I actually kind of silently, secretly did that, but I'm not interested in that. I'm just not. It's not my goal or my thought. I'm starting a hedge fund, and I'm playing around with different ideas on how to manage it and how to, there's different things, and there might be multiple hedge funds. But like one idea I've been working on is the world's first free hedge fund, where there's no management fee and no profit sharing, no performance fee. Huh. Well, that's interesting. Yeah, I just need to, I can't figure out how to do it. I might do it though. If not, I'm going to then focus it on, do you remember these retirement account strategies I was talking about? I'm an entrepreneur, always have been, always will be. And entrepreneurs get screwed on two things: health insurance and retirement accounts. If you work for a big company, you get awesome health insurance, and it's cheap and it's good. And the company says, well, you have to have a 401k. Oh, and by the way, we're going to match you 8%. And you just get free money and a retirement account, and they pay for your health insurance, and it's good. When you own your own company, there's no pension fund, there's no 401k, and you have to pay through the nose. I'm telling you, just me personally, thousands of dollars a month. And then the insurance you get sucks. And you just get screwed. Why? You're an entrepreneur. Oh, you should have worked for a big company. I mean, I hate the idea of that. I really do. So therefore, I'm an entrepreneur, where it makes me mad. Even while I'm talking about it, it makes me mad that the way the industry is set up is like, well, you should have worked for a big Fortune 500 company, but you're self-sufficient, you produce value, you make the world a better place, but we're going to screw you on taxes, we're going to screw you on health insurance, and you're going to get screwed on retirement. I'm like, well, you're welcome. I mean, it's really, 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 really sad, right? So I thought, well, maybe I'll work on that. I'll set up pension funds, or maybe one giant pension fund for entrepreneurs and small businesses to join. And if I can do that, maybe I can fix the health insurance thing. What if we had a giant group? I had 10,000 entrepreneurs on my health plan. And we together are a big Fortune 500 company with a Fortune 500 company type health insurance. Wouldn't that be cool? And you have a Fortune 500 company type retirement account that helps you lower your tax bill and increase the amount of money you retire on. I'm like, dude, I should just do that. So to me, that's interesting. Starting a prop firm, dude, there's a bunch of prop firms and I don't want to do it. It's not even interesting. You can have it. Okay. Oh, the health insurance would not help the pension fund at all. This is what self-employed, solo, and small business entrepreneurs need. It's a contribution. It's not like, how does one help the other? No, it's my contribution to society. But anyways, yeah, they might, right on? But it'd be weird, right? But anyways. mean, I don't know how I could do it. I'd have to talk to lawyers, but wouldn't it be interesting if I had 1,000 entrepreneurs and I paid everybody a $1 a year salary, but you get on the corporate health insurance? I don't know, like, is there a workaround? Okay, we have how do you study the economy? You go to this website. Okay. See? The trial is $8. After that, it's $80 a month. And you will become a macroeconomic genius. Okay? Comes with a macroeconomic training course. So you're like, Wayne, but I need to know macroeconomics first. All right, intro to macro, gross domestic product, fundamentals of trade, terms of trade, supply and demand, solo growth model 1, solo growth model 2, business cycles, money supply, fundamentals, economic data and news reports, financial markets, long run supply and demand. Dude, each one of these is more than an hour long. And you get it included, even with your $8 trial. Dude, if you only got $8, pay the $8. Because people paid, I think it was, how much was this course? Does anyone remember? $500? All right, record on this computer. Awesome. Hey, we even understand what this is. Okay? For China, growing at that 8 or 9% a year from 1986, right? So that's what this market productive.
I take a stab at it.
Or at full productivity, right? We'll call that, potential GDP. And then there are others that are catching up, right? And that's a different. So far, we've only talked about labor and capital, which is fine. And we'll add to these other ones down the road. But these are all things that go into producing GDP. So you got capital, you got labor, and I'll define this in a second, the E part of it, and then ideas. And all of those are factors. The better ideas you have, the better labor force you have, the better capital you have, the more productivity you will have, okay? So that's the standard formula. So again, when we talk about labor, I've always said there's a labor force, L. But I briefly mentioned in a previous one, the more education
it's good, right?
The laborer, the better they are. Now, do you want everyone to be a PhD? Do you want everyone to be a doctor? Nobody's going to be a baker? No, but it'd be great if your baker could also read and write so that they can manage their bakery better because they can calculate ratios and how much flour are they going to need and how much bread are they making per day and when will they run out of flour and when do they need to order new flour, right? That just makes you a better baker, and then of course you won't ever run out of flour, which would be an unproductive day. So you maintain your maximum productivity along the way. So it'd be great. There are a lot of countries where a baker wouldn't know how to read or write. They can make good bread, but they may not be so good at anything else. And then capital, we know is capital. Capital is capital. Capital is good. So what we're going to do is say, in this model right now, it's very difficult to double your entrepreneurialism to double your productivity. So we're going to fix that, okay? And you can't double your labor force overnight to double your productivity. You can't just double how smart
It's great,
your
right?
average worker is overnight. Right? Crust, crispy crust. And they're like, nice. Okay? And you'll see, boom, all of a sudden their productivity has gone up. Same baker, you've just gave them better capital. Then you give them more capital and say, hey, well, you got the first oven full. Why don't we fill the second one? Okay? Take some time, take some effort. Okay? But notice, productivity doesn't double even though he's got twice as many ovens. Okay? So we'll get that. Let's graph this. Okay, output. Okay, we got capital and we have output. So like in any chart, left to right means more capital, right? Bottom, low to high means more output. Okay, so we're going to graph this. And it's similar to potential GDP, which you might have heard me talk about in the past. Think of this, like if you thought your output, like GDP, in the United States, like we saw earlier in this presentation, the United States tends to grow at roughly 2% a year. So every year, 2% growth, 2% growth, 2% growth.
Cool, right?
Harder it is going to be to keep up, won't it? And we show this on the graph through this. So now we've added another oven, but it only made you 50% more productive. Because you're spending a lot of time making, everything changes, right? So inflation in your economy, but it's not easy and you can't do it overnight, right? So you can add more capital, but
See?
more and more capital.
Y is equal to the square root of K. You know this
has
stuff.
its limitations, okay? And there we go. Okay, so the marginal product of capital describes how much additional output is produced with each unit of capital. There's the definition there, marginal. Okay, one new unit is all that means. Okay, the marginal propensity to consume. Okay. And so here.
So this lecture I have to do over the course of like 3 hours. I break it into 2.
Output. So again, one unit here gave you a full unit of output. One unit here gave you almost no, right? Very little, 20% of one unit of capital from one, or 20% of one unit of output cost you a whole thing of capital. And then out here is even less. And it would have to be even smaller. It'd almost be none. At this point, to go from 9 units to 10 units, there would almost be no increase in productivity because you might add another computer, another factory, another.
Well, at least you're taking notes, Jim.
Where every time you go over their house, you're like, holy vey, look at this place. It's a disaster. So we can say, we can throw in an assumption into this model. Whatever amount of capital you have, or whatever amount of more you increase your level of capital, all capital will depreciate. So we can say in this model, hey, 2% every year of your capital is going to depreciate. So if you do nothing after 1 year, you don't fix anything, you don't replace anything, you're only going to have 98% of what you used to have. It will wear out. It will break down. You got a factory? Hey, your machines will wear out. Okay? So we have to build this in the model because it's necessary. Because how do you fix depreciation? And we'll talk about that in a second. Or maybe right this second. Maybe right this second. Okay, yeah, we do. Okay. So let's go back.
I'm telling you, this is good.
You exchanged your pie for money and your money for capital in your... Yeah, oh, for sure.
This is just one lecture.
I need a $50,000 tune-up. Well, what if you had 7 Ferraris? You're like, you can't afford the tune-ups anymore. You spent all your money on your Ferraris, right? So now you never drive them because you're like, I can't even afford the gas, yet alone tune-ups. Every other month you're spending $50,000, right? So more Ferraris are not necessarily better. unless you have unlimited amounts of capital, right? So like what we're looking at here is eventually you get to this point where you're spending all your money on your depreciation. You can't afford a fifth Ferrari. You spent all your money on these Ferraris and you have no money left over to even do the maintenance anymore. You see? Because every Ferrari is expensive. Every Ferrari has a holding cost. And that's what this is.
Sorry, I'm enjoying this.
By the time you buy a computer, it's obsolete.
Dude, this is university
phone,
quality, I
like,
think.
I just bought an iPhone for $1,200. And like, boom, there's a new one. What? Okay? You can't keep up. And then you get to a point where, think of an economy now. How many airports are in your economy? How many roads and freeways, right? How many dams? How many power plants? How many of this? And all of a sudden, all your money goes to just maintaining this. And there's nothing left over for more because it's so expensive because what you have is depreciating. So you get to this steady state, and this is the key, the moment of what we're getting to. When you're a developed economy, it's hard just to maintain that. It's difficult to have all these airports and all these seaports and all these highways and freeways, this infrastructure.
Imagine how many bridges are in America.
Like almost every bridge in America needs to be replaced. Like,
nice.
Holy smokes. Okay. So, you know, economics is a choice, right? $2 trillion can
When
go,
do you maintain your bridge?
COVID relief. Well,
Let's do it next year.
Okay, but you have to decide, right? There was a choice there. So you get to the steady state of capital, okay, where your investment now goes to depreciation. Like, all your money is going to maintaining what you already bought.
Just imagine the United States spends
Okay.
$10 billion a year just
So it's like maybe
maintaining
you
old
get a deal
bridges.
on a mansion, and then you realize it's $300,000 a year to maintain the yard and the upkeep. Like these English, okay.
Oh, you missed it.
Again, you give one guy
Let's add that new
20s
line.
to maintain the yard and the upkeep. Like these English castles or French castles, you're like, oh, look at this! I could buy a castle in France. It's only $2 million, and then you're like, yeah, but it's also $1 million a year to maintain. You're like, whoa, all right? The depreciation is actually more than the value. So anyways, we get to this steady state, and this is what Solo was talking about, and then we're going to add to this in the next lecture, okay? Because we haven't even talked about entrepreneurialism and education yet. This is just capital side, okay? All investment goes to repair and replace existing capital. And this is going to be a problem now. Because this is going to impact output, because we said output is a function of capital, but what if you never grow your capital? Is your economy going to grow if all you do is work to pay,
You see?
right? Like for what you own? Like there's nothing left over and you're not growing. Boris says, why specifically square root, not a logarithm? It's just a model. You, as long as you're showing these diminishing returns is the key idea, okay?
I mean, dude, that's a great, oh my God, that's a great lecture. If your output, your productivity is based on your investment into capital, but you're spending all your money maintaining your existing capital, then your economy will not grow. Now you understand why economies stagnate. I mean, dude, that was just, I don't know, we watched that for what, 15 minutes? Out of a 16-hour lecture, you can see like how hardcore the information is. And that's included for free with your $8 trial. Like, gee whiz. If you don't sign up, I don't get you. What book? Okay, go buy a $300 textbook. I got a bunch of them. I'll sell you one for $250. Or you can just watch that video for $8 and get I would say even a higher level of education than undergraduate economics. I don't think you do solo growth model until you're doing your master's degree in economics. So like, dude, there you go, man. Spend the $8. I'm just seeing I got a bunch of, look at them. I could show you $2,000 worth of textbooks. Okay, these are some of the textbooks I had to buy to learn finance and economics at Harvard. Just some of them. This is thousands of dollars. I don't know where to put it now. I guess I should just put it back. You could just read watch the videos for $8. Hang on, let me put it back. It's heavy. But here's one. Here's one. You're going to get more information from my $8 course, but here's one. And I'm pretty sure, you know, one difference between Harvard and any other university, they all use the same textbook. The only thing is your professor wrote the textbook. If you're at Harvard, it's his. If you go to Ohio State, you all use his textbook, but he's not teaching you. But anyways, no, it is not, Jim. No, it's not going to. I'll do it Monday or Tuesday. So anyways, very cool. So let's get to what we want to look at. Yeah, losing Kurt just took the wind out of my sails. It hit me pretty hard. So I'm going to work this afternoon on all the little details that I didn't finish with FX Bootcamp to make sure you guys are good to go on Monday. So I'll do that over the weekend. Okay. Yields are holding. Oil's up 2.47%. Gold is up 1%. S&P 500, it was down. It's back. Bitcoin and euro dollar about flat. Let me zoom in for you guys. The market is currently mixed. Let's zoom into the risk gauges. Okay, mixed and slightly risked off. So short term, mixed, do nothing. Weekly, a little bit of risk off. So look at buying Swissy, yen, and dollar. See, buy dollar, risk off. Monthly, mixed. So how do you get to this conclusion? We look at VIX, which is volatility. We look at the dollar. We look at the yield on treasury yields. We look at the yen. We look at the S&P 500, and we look at gold. And as a basket, right now, there's really nothing to do. The probability is that you will lose money if you're trading. Okay, and here's an explanation of the basket if you need it. But nonetheless, everything's kind of mixed bag. a little bit risk off. If you look at the scatter plot, this is also a market sentiment indicator. Okay. Right now, oil is the biggest winner today on the scatter plot. What this is telling you, everything, okay, let me highlight this. Let me get a different color. Oh, the drawing tool is glitching. That's interesting. Huh. I got a little bit of a glitch on the drawing tool. But nonetheless, here's the drawing tool. Everything in this quadrant is up, okay, as measured by here. +3, +2, +1, 0. Everything down here is losing money. Over here is the quant box score, neutral all the way to very bullish. So everything in that quadrant inside the pink square was expected to be up and is up. In reverse, these are the things with the negative scores. So I guess I should highlight that in pink. And they're down, and they were expected to be down. Expected yesterday and the day before and the day before that, and they are down. And the other things are the outliers. They're down, but not expected to be down. They're up, but not expected to be up. So not all things are equal. You can see there's quite a bit of dollar weakness there. Okay? But let's get rid of oil. Okay, it's a big outlier. Let's get rid of oil. And then we see the scatter plot is much different. There's not a lot of change in the 10-year T-note. Remember that one trader has hundreds of millions of dollars betting that this goes up. It's expected to be neutral. It is up, but I don't think it's gone up enough. So he might not make it. He might not make his $100 million today. No, your customer, this is very up to date. Not real time, but minutes, not hours. Okay? Cool. Now, if you want to look at, like this is being updated today. We get this data from the Commodity Futures Trading Commission, the CFTC. Okay? And this shows you institutional positioning. Okay? So if you are a fund and you have very large positions in the market, you are required by the government to tell the government your positions. Are you heavily long something? Are you heavily short something? It's required. This information is not like, would you please fill out this survey? No. So the Commodities Futures Trading Commission, every Tuesday they get an update from their institutional investors. So the idea is, people come in on Monday, but Mondays are really busy, but they gather all the information and then they report it by end of day to the Commodities Futures Trading Commission. And then the CFTC updates all their databases and releases it Friday afternoon. So Friday afternoon, we will get the most recent update. And that's where you see not just the total positions per asset by institutional investors, but we can then update ourselves on the flow of capital in or out. So for example, roughly two-thirds of the institutional market is short the Canadian dollar. That is true. But what is also true is we lost 7,000 of the bears. 7,000 contracts short the Canadian dollar or no longer short. There are less bears than there used to be. 7,000 less bears week over week. But at the same time, even though the market's not very long, 13,000 new bullish contracts week over week. Oh my God. Significantly less bears and significantly more bulls for a net change of almost 10% more bullish week over week. Oh my God, is that helpful information? That's not a survey, that's money, baby. That's money in the market. So you're like, well, how does that impact USD kitty CAD? Okay, USD is green, CAD is red. So this is over history. So since November 5th, money has been slowly and then now accelerating into buying the Canadian dollar. At the same time, there are less and less bulls for the USD. So the USD is less bullish, and the Canadian dollar is less bearish, and they're going to probably converge in the next few weeks. And by the time it happens, you probably have already missed the trade because you didn't know. Well, nobody cares. If you don't know, that's your problem. But the information's there. Okay. So both CAD and yen are bearish right now as far as institutional positioning, but you can see they're both less bearish. So it shows you this is probably not a good trade to be long on. They're both bearish and they're both becoming less bearish, and they're not bullish until they get above the zero line. So they're both moving in the same direction. That's probably not a good play. Oh, that's interesting, Wayne. Yeah, it is interesting. I know, right? Well, how does this compare like pound CAD? Is this a better trade? Okay, pound CAD. So green is pound, and it's flattening out, and money is just ever so slowly coming out of pound again. It has been bearish, but then there was a big rally, but now that rally is waning. And so you want to watch this over the next 3-4 weeks. Maybe pound drops back below zero, meaning that there are more bears than bulls. But meanwhile, what about this CAD? So if the CAD goes above zero, it's technically bullish. There are more bulls than bears. And then pound has gone from bullish to bearish, so you have a complete change. Oh my God. So you might say, I'm interested in maybe selling pound CAD. Huh. Not now, but soon, or maybe now, if you can line up your technicals. How many people see the power of this knowledge? This is institutional money, guys. This is hedge funds with hundreds of millions of dollars at play. It's not an emotional survey. How do you feel about it? How do you feel about CAD right now? No, this is money, honey. Solid gold. So from this, we can derive that. What's all the retail positioning and what's all the institutional positioning? And you can find the mismatch. Cool, right? It's nuts, right? The update's not in yet. Cool. And of course, you can plot things out to project the future. This is the euro dollar 7 days in advance. You're like, what? 7 days in advance? Yeah, there's the S&P 500. The middle of next, right? Next week, the end of next week. Whoa, what? Yeah. But anyways, let's go like, let's see the biggest winners of the week. Okay, yields are coming back up. There's no doubt. So here we are tickling 4.0. Remember we were at 5. And I started making money as this fell from 5 down to 3.6. Now we're back at the 4.0. Like I said, I know there's an options play in the market where the dude needs this to go to 4.1. If he makes 4.1, he might make hundreds of millions of dollars today. If it doesn't hit 4.1, he makes nothing. It expires worthless. Oh my God, it's almost noon. Oh, this dude must be sweating bullets. Is there, what time do options expire? I don't even know. It's before 4, isn't it? Is he a gambler then? Oh, for sure he's a gambler. Oh, can you imagine the stomach churning right now? Let's say you put $50 million down. So he's either going to lose 50 million or make $1 billion. Well, what's the difference? Minus 50 million plus 500 billion. Well, that's a big day. Don't let it get away. So anyways, I'm watching that hardcore. Yeah, and based on that, it's their European options, right? Like it does. I think it has to close. I think I misspoke earlier where I said it just has to touch 4.1. If they're European options, it has to close at 4.1. 4.1 is at the money, but considered in the money. So it has to close 4.1000. If it closes 4.0999999, worthless. Okay? Oh, I can't tell you that right now. That's a secret. A birdie told me. I don't know. Maybe it's on the internet. I'm just seeing if it came up in news, live updates, stocks. No. Just seeing if anyone is reporting it. No, so I can't tell you. I'm not going to tell you. I can't. I don't see. Oh, I think it's going to be, I think I see it in here. I haven't read this. Trader makes massive bet treasuries will get slammed after jobs report. Wager targets 10-year T-note rise to, oh, it's 4.15. Oh, it's not even close. Oh my God. And I don't pay for Bloomberg. I don't pip and tell. Anyways, there you go. All right, it's real. We know, all right, that's confirmed. I found it on the internet. How funny is that, huh? Dude, now we can watch this. Anyways, biggest loser, NASDAQ, S&P 500, Aussie dollar, Kiwi dollar. And you knew this weeks ago that this would happen. So I hope you positioned yourself. And I have cash ready to buy. I prepared. I put the cash aside 2 weeks ago. Yeah. I'm like, yeah, stock market's going to fall, so I'm going to buy it after it falls. Very nice. It's good to know these things. Oh, thank you. Did it? Oh, wait, I went over. I'm sorry. No, we'll end right now. I'm sorry, moderator. Your time is very valuable. I can't see my clock is in the office kitchen, so I can't see it. So we're done. We're done. So thank you, moderator. I apologize for going too long. Thank you, moderator. Everybody else, thank you to you for being here for 3 hours and 15 minutes. Thank you to FXStreet for being such wonderful hosts to this webinar for the last 20 years. Not 20 years. This one is, 17 and a half years, this webinar? I think it's 17 and a half years. So thank you, FXStreet, for being a wonderful host to this webinar for more than 17 years. Everybody else, look, follow the logos, okay? TradePlans.ai, it's your virtual coach for free. QuantBox. Dude, if you want to learn how to trade like an institutional investor, I don't think you can without QuantBox. Otherwise, you're just guessing and messing it all up. Trader's Way, again, is a broker that makes money from your success, not your failures. If you think that symbiotic relationship is valuable, please consider them. Visit Trader's Way and open up a demo. There's also Investor Bootcamp for training videos. There's FX Bootcamp for a live performance coach. It's like Tiger Woods getting ready to win the Masters tournament. It's not like, dude, how do I golf? No. This is FX Bootcamp is like Tiger Woods hiring a performance coach, and they're going down the fairway hitting balls and improving so that Tiger Woods is at peak performance right when he needs it so he can win another major. If you need to learn how to trade, Investor Bootcamp. If you need peak performance, FX Bootcamp. So, anywho, right? There you go. Anywho. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful weekend. And I will be doing a quarterly outlook. I was going to do it today. It's not today. But I will do it, I'm thinking Monday. So I'll send out an email and you need to sign up right away. I'm not going to be able to send 10 emails to get you to sign up for $10. You have to be right? Hot to go, HOTTOGO. So I'll say it one more time. We all need to say this as much as possible. Peace on earth.